Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So here we are. It's the end of the first quarter. Hard to believe, one quarter of 2022 is already in the books. We're looking ahead to try to see, what does the rest of the year look like? Clearly the first quarter's been choppy. We had January, February that, didn't look great. March looked good. There was a slight recovery in the markets in March. But there's a lot of stuff going on in the world, and there's a lot of uneasiness and a lot of uncertainty, and that's a lot of why we're seeing all this volatility. So I want to try to unpack just a couple of things, just to let you know, sort of my view of, why I'm either not sleeping at night or why I'm sleeping like a baby, and the reality's somewhere in between. I'll cut to the chase there. Okay, so let's start with some of the latest news. Federal Reserve says it's going to start raising interest rates. They already did one small interest rate increase. They're talking about doing even more here real soon. And they're talking about pulling back $95 billion a month of the quantitative easing that they've been doing for over a decade. So the first comment I want to make about rising interest rates. So yeah, of course, if you increase interest rates, just as we saw recently here over the last week, 30-year mortgage went from like 3.25% to 5% in no time at all. So on a $450,000 mortgage, the increase from 3.25% to 5%, that increases your payment by about $450 a month. So there are many who are saying, hey, that's going to signal the end of the housing market. Builders aren't going to build houses, and we disagree with that. Well, I don't see that at all, because one of the biggest problems we're having in the housing market right now is a complete lack of supply. There's plenty of people who are willing to buy a house, even with higher interest rates and higher prices, if there was just a house to buy. So, we've been underbuilding, especially considering the demographic shift in the United States, with so many younger people coming to age where they would want to be owning a home. We haven't been building enough houses to sort of backfill all those people. So if anything, what we see here, at least for the balance of 2022, is if interest rates continue to go up, the people that were on the margins who maybe could just barely afford a house at 3%, well, okay, so they're going to have to keep renting, but there's still plenty of people to consume the inventory, even at the higher interest rates and higher prices. So we're not really looking at that as a drag on the economy. We're just sort of seeing it as, that section of the economy sort of settling out to a more, reasonable level where more inventory comes on, and then maybe we get to the point where housing prices stop accelerating like they're doing right now. The other thing I wanted to mention is, as they're raising interest rates, there's some thought, or at least a comment by the Fed, that says, well, they're doing it because inflation is high and they're trying to do something about inflation. Well, I'm going to show you a quick chart here, and it shows the amount of, the amount of debt people have as in comparison to the amount of disposable income. And what you see in this chart is that the amount of debt people are carrying as a percentage of disposable income, it just continues to fall. So it's not like people have been borrowing money at low interest rates to just go spend, because then the amount of debt that people had as a percentage of disposable income would be climbing, not falling. So in our view, it's not the interest rates that have been causing inflation. It is, in our belief, the fact that the federal government and the Federal Reserve have, over the last 2 years, basically inserted $10 trillion. I think I read that number yesterday. $10 trillion into the economy over the last 24 months. Well, there is the definition of inflation, right? When you have too many dollars chasing too few products and services, and we have a deficit in products and services because of all of the shutdowns that occurred through the pandemic. So, inflation occurs. But it's not because of the economy, it's because of all the extra dollars the Federal Reserve and the federal government inserted into the economy. Now, I'm not commenting about whether they did the right thing or the wrong thing. We were sort of in unprecedented times over the last couple of years. But we have to recognize, well, where are we now and how did we get here? And so we like the idea that the Federal Reserve is going to start pulling back about $95 billion a month. But nobody should be under the illusion that, over the course of a year, that's going to somehow change the inflation rate. Because what nobody's talking about, and I've mentioned this on prior updates, is that, yes, the Federal Reserve is going to be pulling back $95 billion, but like $3.8 trillion of the money that the Fed had already printed and given to the banks just deposited back at the Fed. So before a single dollar comes out of the economy, you got to burn through $3.8 trillion, and that's going to take 3.5 years at $95 billion a month. So the Fed's actions right now, I think, are late, but they're welcomed. I mean, interest rates have been entirely too low for too long. This quantitative easing has been going on for way too long, and the Fed's balance sheet at $9 trillion is ridiculously high. But we should not delude ourselves into thinking that their actions are somehow going to solve the problem. So what's going to solve the problem? Well, one of the first things that we look at is how much of the current inflation problem is as a result of the conflict that's going on in the Ukraine. And it's a pretty big chunk. I mean, when you look at what's happened to energy prices because we've cut off Russia, you can see, and that's a big chunk of where the inflation is coming from. We also are seeing some product shortages. We're seeing some, a lot of people are learning for the first time how much metals and materials and wheat and oil the rest of the world was getting from Russia. And so as we basically isolate Russia, we got to find ways to backfill those supplies from somewhere else. So there's going to be some short-term disruption, but I'm actually pretty positive about it. Just like as I was, some people may recall back when the prior administration was doing tariffs on China, and I said, well, yeah, that's going to cause some things to cost more in the United States for the short term. But what we saw in pretty short order is companies diversified their supply chains away from China so that they could continue to sell people the goods and services that they wanted without being so heavily reliant on China. And I see a lot of the same thing likely to happen as a result of what's going on in Russia right now. Dirty little secret, I read this over the past week. The United States government pays farmers to not plant crops in many cases. And it's not like off the charts. It's not going to solve the problem with a shortage of wheat anywhere. But it's just sort of a message that if the federal government is telling farmers we're going to pay you to not plant, then there's excess capacity in the United States that if we just stop doing that we could start maybe backfilling some of the shortages and get other countries to do the same. Same thing goes for energy. Germany was heavily reliant on Russia for natural gas, and we in the United States have an abundance of natural gas. If the government can just allow us to do more exporting as we were a couple of years ago, then we can basically start to wean more countries off of Russia and find better places to get these goods and services from. And I do think because of how quickly companies are able to adapt in the United States, that we can be a big recipient of that. Now, there is one potential that gets in the way of that, and it's the government, sad to say. There's an election coming up in about 6 months. My preference always is divided government. I never like it when one party controls everything because that tends to send a message to publicly traded companies that, hey, the rules of the road are going to change, so maybe we should sit on our cash for a while. So I'm hoping that and all of the indications right now is that after this next election, we should have a divided government. And what that tells publicly traded companies and businesses in general is that, okay, There isn't going to be a lot going on in government. They're not going to be changing the rules of the road every other day. And so maybe we can start putting more of our capital to work, and capital to work in ways that try to offset some of the shortages we're experiencing as a result of the conflict war in the Ukraine. So I could literally go on for 20 more minutes about all this, but what I want people to take away from this is, yes, inflation is high. It's higher than we want it to be, but it's not a guarantee. Oh, there is one more thing I wanted to talk about. Sorry, I'll just take 30 seconds. There's this thing called the yield curve, and the yield curve is basically the difference between a 10-year and a 2-year treasury. And just recently that inverted, and I saw in the news that, 7 out of the last 8 times that the yield curve inverted, that was a sign of an impending recession. And then I read further in the article and it said, and the average amount of time between the yield curve inversion and the recession is 18 months. And I just was like, then who's to say that the recession that followed a yield curve inversion was actually because of the yield curve inversion and not something else? I mean, 18 months is a really long time. So I'm not at all worried about the yield curve inversion as a predictor of a recession. A recession is going to happen, I think, if the Federal Reserve starts taking even more action to actually slow down the economy, because what we need to do is get this excess cash that they dumped into the economy out, get as many people that were on restrictions because of the pandemic off of restrictions, get our manufacturing and service capacity back up to where it was, and then we don't have to have a recession. And all that is very possible, and I think almost likely, because if there's one thing I know about capitalism in the United States, is companies don't want to sit on dollars when inflation's at 7% and you can earn 0.2 at the bank. They want to put those dollars to work and start making some money. And so we're going to follow this pretty closely for the rest of the year, because if inflation stays at 7% for the entire year and into next year, I mean that can seriously erode people's ability to afford things, because wages are not going to keep up with that, not likely to keep up with that. But as it stands right now, we're not like making any serious withdrawals from the market. We're doing some slight reallocations into some areas that we haven't been in a while, just to be maybe a hair more defensive. But we're not like losing sleep at night. I'm certainly not losing sleep at night worrying about is the U.S. economy about to collapse. There is a tug of war going on, no doubt, between getting our ability to produce goods and services back up and above pre-pandemic levels, at the same time that the Federal Reserve is trying to slow down the economy, or at least try to lower the inflation rate. So those two things are going to be sort of fighting each other for a little bit. But I wouldn't be doing what I do for a living if I didn't believe that the free market and capitalism, sort of given enough time, takes care of these sorts of issues. So if the Federal Reserve decides to do something really crazy, like raise interest rates by 1% at the next meeting, we're probably going to change our minds. If they start pulling out $400 billion a month, then we can actually start seeing some real impacts from their actions. But as it sits right now, we're not overly concerned about it, and we don't think that you should be either. So, sort of a long-winded update. Apologize, but there's just so much going on in the world, and we just want you to know that we're here looking. If you have any questions, like about anything that I've talked about, or any concerns you might have about the market, the economy, just anything financial in general, please reply to this update, send me an email, give me a call. I'm happy to answer any questions from anybody that's willing to ask them. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.